Is all your money sitting in a high-yield savings account? High-yield savings accounts don't mean high gains. Benjamin's story introduces the first steps you can take to begin a more diversified and profitable strategy for investing. So, you've got some cash saved up, maybe around $1,000, and you're wondering what to do with it. Keeping it all in a high-yield savings account isn't the only way. You can make a solid emergency fund, but you're missing out on opportunities to grow your wealth faster. Let's explore some smarter moves. One of the easiest ways to get started is with an S&P 500 index fund. Think of it like buying a little piece of about 500 of the biggest and most successful companies in America. It's instant diversification, meaning your money isn't riding on just one company doing well over the long term. This index has averaged returns of around 10% per year. Even Warren Buffett, one of the most successful investors of all time, suggests that most people would do great by simply buying and holding an S&P 500 fund. It takes a diversified portfolio to the next level at a low cost. If you want to spice things up a bit, consider buying small pieces, what are called fractional shares, of about 5 different stocks. It's like creating your mini portfolio of companies you believe in, of course. You need to do your homework and understand what these companies do and what are the risks involved, or you are simply gambling. This can be achieved through consistent balance reviews. Some brokers, they'll let you buy a fraction of a share, so you don't need to shell out a ton of cash up front. Creating great financial habits. It's a chance for a solid diversification. Just be aware that individual stocks can be more up and down than an index fund. So keep the potential risk in mind. Now, what if you're saving for something relatively short-term? Like a down payment on a car or house? Then a high-yield savings account is a great choice. It's a safe place to keep your money. And you'll earn more interest than a regular savings account. Just make sure you check out a few banks to find the one with the best rate and the least amount of fees. It's still an important tool in your investment plan. Not sure you want to pick stocks yourself? No problem. A robo-advisor can do it for you. You answer a few questions about your goals and how much risk you're comfortable with, and the robo-advisor will create a portfolio and manage it for you. It is a great affordable advisory with digital technology and also manages rebalancing and keeps everything on track. It's a simple way to invest with very little effort, and you can begin with low minimum opening balances. Looking for something super safe? Take a look at I-bonds. These are savings bonds from the U.S. government that protect your money from inflation. The interest rate changes based on inflation, so your savings keep up with rising prices. There is an affordable balance that allows steady and manageable allocation. Another hands-off option is a target date fund. You pick a fund based on the year you plan to retire, and the fund automatically adjusts its investments over time, becoming more conservative as you get closer to retirement. It really helps you in financial planning. Before you get too deep into investments, take a hard look at any high-interest debt you might have. Like credit card balances, paying that down can save you a ton of money in the long run. The interest you're paying on that debt is likely way higher than any returns you'd get from an investment. You could consolidate the debt for further gains and greater opportunity to pay it off in full. Think about investing in yourself too. Take a class, get a certification, or learn a new skill that can boost your career prospects and your income potential. This is one of the best investments you can make for yourself in the long run. That increase in income could be capital for higher investments and greater returns in the future. Of course, before you start doing anything, make sure you have an emergency fund. This is money you set aside for unexpected expenses, like a job loss or a big medical bill. Aim for 3 to 6 months worth of living expenses in an easily accessible account. Think of this as a financial safety net for the portfolio and other assets in your portfolio. Some other options you might want to check out include money market funds and treasury bills, which are lower risk and pay dividends or interest respectively. They offer stability and are a great asset to have with your money. But remember, it is all about finding the balance of how much you can allocate and the returns you can be hoping for. So what's the absolute best way for a beginner to invest that first $1,000? Well, there's no single answer. But starting with an S&P 500 index fund is generally a solid move. It gives you diversification and a good shot at long-term returns. You can invest that cash for shares in several investment vehicles and then earn dividends on top of your investments. Can you actually invest in stocks with just $1,000? Absolutely. Lots of brokerage platforms will let you buy partial shares, so you can start small and build your portfolio over time. What's the safest way to invest that $1,000? Probably a high-yield savings account or those I-bonds we talked about. You won't get rich quick, But you won't lose sleep worrying about market crashes and be virtually risk-free. And how do you turn that $1,000 into, say, $10,000? That takes time, patience, and a consistent strategy. You can invest in things that have a good opportunity for growth like single stocks, but also have compounding funds. And of course, you have to keep adding to your investments regularly. Dollar cost averaging can be a way to minimize the loss when investing during a long-term period. But remember, while we've covered a lot of ground here, everyone's financial situation is different. It's always a good idea to do your own research and maybe even talk to a financial advisor before making any big decisions. One thing this video doesn't cover is the nuances of tax loss harvesting with individual stocks and the potential complications it can create, especially when untangling a portfolio later on. We also didn't dig into the nitty-gritty of robo-advisor algorithms and whether their factor-based investing strategies truly outperform simple market cap indexing over the long haul. These are topics you might want to explore further on your own. So if you found this video helpful, give it a like and share it with anyone else who's just getting started with investing. And don't forget to subscribe to the channel for more tips and tricks on building your wealth and securing your financial future. Thanks for watching.